All right, we are at time, so let's go ahead and get started. I want to thank everyone for joining us to the Around the Valuation World International Webcast. My name is Chun Chun, and I'm with NACVA. Before we get started, I want to go over a few housekeeping items. First, to obtain CP credit for this webcast, you'll need to answer all the poll questions that pop up on your screen during today's webcast. If you have an AVW International subscription with us, you're able to receive the CPA certificate within 7 to 10 business days after today's webcast. If you are interested in obtaining CPE and you don't have a subscription, there is a link in the materials that you can click on that will direct you to the webcast. If you have any questions during today's webcast, please use the Q&A feature in Zoom. It's also be directed to the presenter. Wolfgang will collect those questions and send them over to Antonella. If you have any technical questions about Zoom or a question about any CBA, please use the chat feature. It's also be directed to me. With AVW International and also AVW, the domestic US one, we try to offer highlights and upcoming topics in the industry. However, there are a lot of different topics to come up and we can't cover every single one of them. So there is a link to some different resources where we sometimes often pull articles from. So if you'd like to get more information, please click on those links for additional resources. And today we have Wolfgang Nies and Andrew Newman as our technical editors who are joining us today. We also have Pratik Shah and Brian who are unable to join us at this time. And with that, I'm going to turn the time over to Wolfgang, who will get us started for today.
Yeah, thank you, Chanda. Welcome to everybody from Germany. First of all, I would like to share a short video on the Business Valuation Financial Litigation Super Conference in Las Vegas in December. So let's have a look.
Thanks for sharing that, Wolfgang.
Sorry.
Not a problem at all. One thing I just want to jump in real quick and just let everybody know that the conference agenda has been released. It was released last week. And in the materials, there is a link on that page. So if you're interested in joining and you want to know who will be presenting, feel free to access materials and then click on that link. Thanks, Wolfgang.
Okay, thank you, Chanda. And sorry that I lost the music in the back, I think. Yeah, one more conference also in December, 1 week earlier. So December could be the conference months. It's our conference in Germany. It's our EACVA Business Valuation Conference in Düsseldorf this year, December 5th and 6th, with a variety of topics. We will touch ESG, sustainable finance in our keynotes, also as economics. And then we have a colorful buffet of different topics, AI, business model innovations, business valuation in Italy, intangible assets, terminal value topics, also credit pricing credit risks, which will match with our today's topic, as well as private debt valuation. So you see, this topic today is a hot topic. It's a more or less new topic in the venture capital and private equity market, and we will also take care on this during our conference in Düsseldorf. So feel free to have a look at valuationconference.de, and we are near the airport, so you can directly take the plane from Düsseldorf to Las Vegas and share the next conference 1 week later. Having that this, it's a great pleasure for me to introduce Antonella Puca. Stop sharing my screen. Antonella is partner with Bluewell in New York. She is specialized in valuation of private equity and venture-backed companies for financial and tax purposes, M&A transaction, buy-sell agreements, financial and tax reporting, and so on. She has more than 20 years of experience in alternative investment industry. Her focus is on valuation of high growth companies and complex securities at fair value to private equity, venture capital, hedge funds, including option pricing topics and Monte Carlo simulation. She gave a brilliant presentation last year at our conference in Berlin. She wrote this fantastic book, which you can't see because of my slide in the back, Early Stage Valuation, a Fair Value Perspective. Very, very interesting and a lot of examples and nice to read, very good. She's been qualified as an expert witness in the state of California. She has served on the Business Valuation Committee of the American Institute of Certified Public Accountants, as a member of the Research Committee of the Alternative Investment Management Association, as director and treasury of the board of the CFA Society of New York, as a director at the CFA Institute. She is an instructor for AICPA Business Valuation Training Program and also consultant on the CFA Examine Development Team, and a lot more and more and more. So it's a great pleasure to have you here, Antonella, and I look forward to get in. For me, it's the first impression of the debt financing situation from a venture capital company. So the topic is valuation trends in private capital markets, focus on venture debt. And it's a pleasure to hand over the micro to you, Antonella.
Wolfgang, thank you so much for your presentation, for this great invite. It's always a pleasure to collaborate with you and your team, and congratulations for all the work you are doing across Europe and also in the US in collaboration with the US branch. We can go to the next slide and next. And next. So in our agenda today, we'll cover briefly an overview of the private capital markets and with a focus on venture debt. And we then will provide some examples on how to value venture debt, particularly venture debt which has equity features, either because it's issued in conjunction with warrants, or also because it's just it has embedded options, as in the case of convertibles. Next. And next. So private market overview. I like to start always from what's happening in the central bank environment. And that's because it's clear that this is having a very significant impact on the state of the private markets, as well as on the general level of interest rates, both in Europe and in the US. So this graph shows the total central bank assets of the European Central Bank from the end of 2019 to the end of the month July 24. So for those of you who were at the conference in Berlin, you are already familiar with this slide. I just updated it to the end of July, and you can see that a very significant event has been the fact that during the pandemic period, the total assets of the central bank have literally ballooned. I mean, they went from a 4.7 trillion euros at the end of 2019 all the way to a max of 8.8 trillion in June 2022. So we are talking, close, not just double, but, quite close to that. And since then, we have seen a gradual decline, which, as we will see in a moment, has been quite much faster in Europe than in the US. So currently we are at 6.5 trillion for the European Central Bank. So we have done a lot of progress in kind of decreasing the total assets. And if we look now at the next slide, which shows the US situation. Okay, here you see that the US has not been as aggressive as the Central European Bank in reducing total assets. Part of the reason has probably, I mean, this is subject to speculation, but we can also speculate about the fact that it might have to do with the forthcoming elections. So people have been quite careful in making changes that may affect the economy in a significant way. So we have had a reduction in the US, but not as strong as in Europe. And the reason why I'm focusing on that is because the total assets is just one of the indications of money supply in the economy, and the fact that the total assets have increased so much has gone parallel with an increase in money supply. And in order to maintain these high levels of assets, there has also been some pressure upward on interest rates. Which leads us to the next slide, which shows the trends in interest rates over the past about 5 years. So again, from the year-end 29 to July 2024. So as you can see, I mean, we're all aware of the fact that interest rates went up a lot in around 2022, September, and then they kind of stayed at about around the same level. I mean, they've been oscillating, but not really decreasing yet. And part of the challenge is because, to the extent the total assets are still so high, there is some pressure, so to speak, at keeping them at that level. Having said that, I mean, we all know that there's been recently an announcement in the US that there may be a forthcoming cut, but that's something to monitor. And the reason why also this is so important for us is because one of the features that distinguishes venture firms from other types of firms is the fact that they need to turn to the capital markets on a recurring basis to sustain their operations. So the availability of capital in the market is critical, especially for venture companies to be able to stay in business and to pursue their business plans. These are companies that are not self-standing. They're using cash. They're not generating enough cash to sustain their operation. So the access to the capital markets for them is critical. And at the end of the day, the availability of cash determines their ability to stay in business, as well as the cost of capital. So going to the next slide. So now with that, we can see that generally speaking, both for the PE and the VC market environment, this year has been quite challenging. So there has been a significant decrease in capital raising, both in the private equity and in the venture capital realm. The section on the right shows the situation in private equity. The section on the left shows the situation in the venture capital, and for both, you see what the situation is. Consider that the 2024 information is only as of June. So if you want to compare it, you have to, you can double it, or you can make an estimate of what the next 6 months are going to be for comparison. But the idea, though, is that there has been a decline. Next. So at the same time, we see that cash is still sitting on the lines. So here we have the data, that we can see show there is still significant cash available for investment, which is a good sign. Next. So same thing in the VC space. You see capital raised versus capital invested. Generally speaking, all these indicators point to the fact that while capital raising has decreased, there is still a good deal of capital sitting on the sideline that's waiting for investment opportunities. Next. And again, a negative sign is the fact that both in the PE and in the VC environment, deal activity has decreased, both in terms of number of deals and in terms of value. Next. Another interesting sign, now we have the data for the US. Here, we don't have data for Europe, but here you can see that there has been also, how is this affecting valuations at the end of the day? So we can see that there has been an increase in the in the percentage of flat and down rounds. We are actually at historic highs in that space over the past 10 years. Having said that, there is still a sound 72.6% of rounds that are taking place at higher valuations than before. So that's, I mean, having about 27%, 27.4 of flat and down rounds is not all that bad after all. I mean, it's still worse than it was, but it's still, reasonably good. And going forward, an exit, I mean, that's an area where we see a lot of challenges these days. I mean, you can see how the drop has been, very significant in 2024 relative to the preceding year. Next. And particularly in the IPO space, very challenging environment. Next. Now, the interesting thing is that, most of the signs that we've seen are pointing downwards, putting downward pressure on valuations and pointing to a more challenging environment this year. The venture debt has been a rather bright spot in this environment. So, and this is partly why we're focusing on venture debt now, because venture debt, if you look at 2014, you see how much smaller the market was than it is currently. And we'll explore in a moment why that could be, but this is a phenomenon. So there has been, in spite of the challenging environment, there has been essentially a quite robust market in terms of venture debt. Next. And here you can see that also in terms of number of deals and deal counts. Next. So this is we looked at Europe. I mean, this is just to confirm that in the US, we are basically experiencing the same trends. The size of the trends might be a little different, but still, even in the US, venture debt activity has been quite strong. Next. So in summary, from this overview, so total assets, both in the US and for the European Central Bank, remain at historic highs. There has been an effort to reduce assets by central banks and bring them more in line with pre-pandemic levels, but we are still kind of in the high range, and interest rates are still close to their 5-year highs. Private equity and venture capital markets remain challenging, but having said that, and particularly in the exit space, it has been very challenging this year so far. But on the positive side, there is still significant dry powder sitting in the sidelines, and venture debt has provided a relatively bright spot in the overall private capital market environment. So that's our capital market summary. Now, let's look a little bit more closer now at venture debt. So first of all, what do we mean by venture debt? Venture debt is debt that's provided to venture capital companies, which for purposes of this presentation, we define as companies that may be at various stages in their development, but have two critical features in common. Number one, they have high growth rates of revenue, or generally high growth. And number two, they are still not profitable, hence the need to turn to the capital markets on a recurring basis to raise capital. So typically, I mean, these companies have a complex, generally have a complex capital structure, which consists of various types of securities, preferred, common, warrants, options, and so on and so forth. That has, I mean, traditionally was not necessarily a primary source of funding. Why? Because that needs, I mean, banks were kind of reluctant to provide the financing to these companies. That's why they were turning to equity investors. But recently, as we saw, there's been an increasing amount of debt flowing into these type of companies in various shapes and forms. First of all, there common type of venture debt consists of bridge loans. These are loans which can be provided by current investors, sometimes even by founders, by banks that specialize in this type of investments, that help the company reach a fundraising event, a significant fundraising event in the form of preferred stock generally. So these are loans that are meant to be short-term, that are repaid, within a few months from issuance. The second type is term loans. Term loans tend to be longer term. We often see loans that are issued with a 3-year term as almost as a standard. And these loans can be, very often they take the form of multi-tranche loans. This means that basically the loan agreement, for instance, may indicate that there's going to be a loan of 50 million euros given to the company, but the 50 million don't come all at the same time. They may come in tranches. First, the company gets 5 million, then 6 months down the line, they may get the other 5 million, provided they meet certain thresholds, and then the remaining 5. So sometimes these multi-tranche loans end up being paid in full. In other occasions, they may just take the form of having just one tranche, depending on the company's performance. Also, term loans may have different level of seniorities. And one feature that's quite common in a venture capital environment is that they typically have some sort of equity kick. In the form, most often in the form of warrants, which are associated with the loan. And these warrants allow the investors to participate in the capital gain of the company if the company does well. Then we can have credit facilities like line of credits, and then other types of loans, convertible loans. Again, this is a hybrid type of loan where you have the debt component and the embedded optionality. Again, that's to enhance the participation in equity. And then, sometimes some of these loans may turn sour. So there are possibilities also to invest in distressed debt. Next. So what are the benefits of venture debt? So venture debt, from the company perspective, venture debt can be a source of non-dilutive capital. Having said that, obviously convertible loans don't fall into this pattern. And also, we saw there are often equity kickers associated with the loans. So that's something, to keep in mind, but it may be less dilutive than equity, but it still can be dilutive at some level. Also, venture debt can be used to supplement an equity raise. So not just as an alternative, but as an enhancement. And we saw how, particularly for bridge loans, venture debt can provide a short-term source of financing. And a very important point is venture debt tends to be senior to preferred equity. So one of the reasons why we can speculate that venture debt has been a bright spot in the current market is because it provides greater protection than any type of preferred equity that follows it in the cap structure. And also, another very important feature, is particularly in certain industries like mining, for instance, is that venture debt can allow significant flexibility on a number of different terms, like interest calculation, equity kickers, amortization, repayment, collateral, and so on and so forth. So it can be, this is quite specific also to venture debt. I mean, venture debt is highly negotiated, and you can have a lot of flexibility in how you want the venture debt to be set up. Next. So valuation. So we have some quite specific guidance out there on how to value venture debt under fair value standards. Particularly our AICPA guide to the valuation of portfolio company investments dedicates the whole of Chapter 6 to the valuation of debt instruments. Then Chapter 10 addresses how to apply calibration in valuing a debt investment. There is a case study that exclusively deals with debt valuation. And then we have also some guidance, key guidance in the International Private Equity and Venture Capital Valuation Guidelines, which I can will review in a moment. Next. So what are common departures from GAAP that we observe in practice? And this is an area where traditionally, I mean, there are firms out there, including investment company, that have, they're still using certain approaches which are not really necessarily GAAP compliant. So valuation at par. So if there is a sufficient enterprise value to repay the loan, sometimes firms think that it's okay to value that at par, meaning basically at face value. This is generally not consistent with IFRS and also with US GAAP. Why? Because par value or face value or cost is not automatically fair value, even if there is sufficient enterprise value to cover the liability. First of all, you can think of it this way: if you may buy a loan at a discount. There may be an OID, so using face value right there would give you an increase in value on day one. That's not acceptable. So it's something to be considered, and some people still do it, but it's not really GAAP. Next. Another common departure from GAAP is to value debt at amortized cost. Okay, that's actually, there are still quite a good deal of funds that do that. IFRS provides some ambiguity on this topic. Also, this is a methodology that's typically used in the banking world. So some funds think it's okay because they take it from banking, but US GAAP is very clear on this point, that investments have to be reported at fair value, not at amortized cost. What's the difference? Amortized cost is basically when you value your debt, let's say that you enter an investment, you pay for it 4 million euros with a principal of 5 million. So, and then let's say that this debt has 5 years of life to maturity, and then there's this 1 million difference, and you amortize it over the course of 5 years. That's the idea behind valuation at amortized cost. So by the time you get to maturity, the loan essentially is worth par. Well, that's not what GAAP allows, US GAAP, and the reason is, and you see it in the IPEV guidelines, Fair value assumes an hypothetical transaction at the measurement date, an exit transaction. So the idea is that you have to value your instrument assuming that you're exiting on the day of valuation. And in that case, that's not going to be your amortized cost. Normally, it's going to be whatever the market tells you the price or the value of that instrument is, depending on the general level of interest rates, depending on the credit risk of the company, and so on and so forth. So there are still some auditors that accept amortized costs, but the industry is moving away from that, and that's something to be aware of. More and more people are not going with that anymore. So next. So what is the methodology that should be used for fair value? Definitely under US GAAP and under IFRS as a generally acceptable method, plus any time that's clearly stated in the agreements that you have to use fair value. So even if IFRS can tolerate it, if your fund or is stating that you have to use fair value, that's the method. It's not amortized cost. It's what is called the yield method. And there's a very clear description, I think, in the IPAV guidelines valuing that instruments. So the fair value of that instruments in the absence of actively traded prices is derived from a yield analysis that takes into account credit quality, coupon, and term. So the yield method is a variant of a discounted cash flow analysis. And here it tells you say, I want to read it because I think it's very clear. At the initial investment, the inputs are compared to observable data when available. For example, at inception, the internal rate of return for a given debt instrument can be derived by subtracting the risk-free rate from the implied IRR. So you can figure out at inception what the implied IRR is. And you can decompose that into a market rate, risk-free rate, and to a credit spread that goes on top of that. And then once you get to subsequent measurement date, you update both the risk-free rate and the spread to reflect company's performance, trends in interest rates, trends in the industry. And you then apply the new yield to value your debt. Now we'll look at an example. Next. So this is a list of key terms in VC debt that you need to be aware of once you are valuing your instrument. These are all things that can change depending on the agreement, particularly in the VC environment where there is a lot of flexibility in structuring debt instruments and debt indentures. You need to look at each of these to figure out how they are applied. Next. And here is a basic application of the yield method. So we are at calibration. At the inception of the deal, you disbursed 7.5 million for this investment. You estimate the cash flows. You see that the first cash flows are going to have a peak interest. So the first months of interest is not going to be paid. It's going to be accrued and become part of principal. And then, starting in January of 2024, cash interest started to be paid out according to the indenture. And then you have a final repayment in December 24. So based on this cash flow schedule that you can essentially build from the debt agreement, and based on the actual amount of cash that you disbursed at inception, you can calculate an implied yield of 17.1%. That's an application of the yield method at the calibration. Next. Now we move forward. Now we go to the valuation date. Okay, a few months have passed. And what do we need to do? We need to update essentially three components. One is the risk-free rate. The second is the industry spread. And the third is the company-specific risk premium. And we're going to look at the example in a moment. So next. So this is an example of a yield analysis, very simple. So our debt was issued on June 15, 2023. That's when we did our calibration analysis. We paid, if you recall, $7.5 million, which is 94% of par at that time. We estimated a yield of 17.1%, implied yield based on the debt indenture. So at that time, the reference rate for a 1.5-year loan was 5.1%. So the spread was 12%. So the implied yield is composed of two components here, the reference rate and the spread on it. Now we go to the valuation date, which is now June 30 of 2024. So we only have half a year left because the debt matures on December 31st, 2024. So now we look at the markets in the second set of boxes up there. So we look at the markets and we see that for a B-rated reference loan, the market spread over the risk-free rate for all corporates is 1.7%. It was 3.8% at calibration. And that the materials, particularly for this particular loan, is a company that's operating in the materials industry. For a 0.5-year yield for a B-rated loan, we get 2.5% of spread. Now, why are we using B-rated loans? Our debts instrument is probably not B-rated. It might be lower than that. It might be a CCC, for instance, but we're still using B because we are looking really at the industry spread and we want to have something quite stable. If you go below B, you really start having a lot of volatility and it's hard to figure out really what happened to the market. So we typically use B-rated loans as a reference. So here, now we see that. Now let's go back to the bottom section of this page and we see what happens to our yield. So first of all, we start from our origination date spread. So this is the spread that was there when the loan was first issued. And we know from what we saw in the first column that it was 12%. And now we apply to that the change in spreads. So there has been a 1.3% decline in the industry spread related to the materials. And also we add another component, which is the company's performance. So in this case, the companies perform quite well. So the risk spread, the spread related to company-specific risk has declined by another 1%. So the new concluded spread now is no longer 12%, has become 9.7%. So we add that on top of the reference rate. Now the reference rate is going to be for a 0.5 year term, no longer 1.5. We only have half a year through the maturity, and we get to a new discount rate of 15%, a new concluded yield of 15%. So we apply that to the new principal, which is 8.5 million. Now, actually, we apply that to the new set of cash flows, considering that now the principal is no longer 8 million, but it's the 8 million plus all the PIK interest that has accrued over the prior months. And we get to our valuation, concluded fair value of 8.4 million. Next. So that's how the updated model works. Now, other debt valuation challenges, transaction costs. So sometimes, typically venture debt is issued with the original issue discount. And also there are typically, there may be collateral maintenance fees, commitment fees. So some of the OID is included in the DCF. Collateral maintenance fees and commitment fees are typically excluded. And other challenges occur when there are multiple tranches. So how do you model those tranches? Do you consider them as part of a single deal, or do you creating one essentially DCF including all the tranches and all the cash flows, or do you consider each tranche as if it were like almost like a separate loan? So that depends really on the terms and on the flexibility that is embedded in the contract. I mean, to the extent the borrower, the lender can get out of the loan under certain circumstances, so there's not really technically really an obligation, or there are ways, relatively easy ways to get out of the commitment, then it might make sense to model them as separate loans, separate with a separate DCF for each tranche. On the other hand, if it's pretty clear that that money has been committed, has to be paid, it's just a question of, you know, when, and there is not a lot of discretion, then it might make sense to instead use a single DCF. Next. So now let's take a look at warrants. So in many cases, venture debt is going to have some level of equity kickers associated with it. So the very important point here for purpose of fair value is that the valuation of debt at inception must be adjusted for the value of the equity kickers, whether they're options or warrants or depending on what they are. But if those are received as part of the loan transaction, your calculation of the implied yield has to be adjusted for those. And if not, you're going to end up with yields that are likely to be understated. So now let's see what happens next. And next. So this is an example of how you would apply the yield method with warrants. So first of all, we are assuming here that you have a company which has so you have a company which has a stock price of 1.04 and a strike of 1.12 in the so this company is issued that with warrants. And how do you determine the stock price? I mean, you could have a situation where the company is public, even if it's an early stage. This happens quite a lot in the mining environment. You can have companies that are still in the development stage and exploration and developments. They don't have any revenue, but they may be listed. So you have your stock price that comes from the market, or you can get to an estimate of the stock price by other means. So in any case, you come with this conclusion that the stock price is 1.04. You estimate the volatility, you have the term to expiration of 1.5 years, the risk-free rate is 5.1%, and the debt was issued with 1.2 million warrants, so you estimate the value of the warrants at $447,000. So you paid for this term loan plus warrants in total, you paid 7.52, which is what we saw before. You have, what is the term loan really worth? I mean, at the inception, when you purchase this, you have to back out the value of the warrants from that. So here we have split the 7.5 into the warrant piece, which is 447, and the term loan, which is 7072577. Next. Okay, now that's what's changing. Now compare this to the slide that we covered before, to the yield method analysis we went through before. So there, the present value of the loan at origination was 7.5 million. Now we have backed out the warrant, so the value of the loan, given the same exact cash flows, estimated cash flows, is now 7.072. So this gives you a yield of 22% at the origination. It's no longer 17.1, it's actually 22. That's a big difference. So that's the yield that you would have to use as the basis for your yield analysis. It's no longer 17.1 because there were warrants. It's 22%. Next. So for convertible notes, we have some of the same issues. Here, we typically for convertibles, we often use a scenario analysis. So you have very often two scenarios. You can assume that the note is going to be held to maturity, or you can assume that it's going to be converted into equity prior to the maturity date. So in any case, when you use when you have a convertible, you have the same issue that you need to split the option component from the bond component. So even in this case, the option is not issued separately as if you had a term loan with warrants, but it's actually embedded in a single instrument. So, but from the point of view of the analysis, a similar idea. I mean, you still have to analyze the option, determine what the option is worth, back it out of the initial investment, and calculate what's the pure bond piece really valued at inception. Another methodology to value the convertibles is to look at them as if they were a more senior type of preferred. When is that suitable? When you know that you are pretty confident that the note is going to be converted. So at that point, it doesn't make sense to use a note to maturity scenario. You just consider the convertibility feature and you essentially include it in the cap structure, which is what we're doing here. So here you have a convertible note of 5 million. Which would convert now, which is typical. First of all, this note gives you an interest. So this interest is a PIK interest. It's accrued to principal. So at 8% in this case. And then there is also, in addition to that, there is also the fact that when the note converts, it effectively converts at 80% of par. So basically, if you have $1 of principal in the note, that's going to give you more than $1 because it's as if you had a 20% discount on the converted amount. So in this case, we are considering a situation where the note is converted. Well, first of all, yeah, let's go to the next slide now. Okay, so here we're assuming that at the time of conversion, which could be, let's say it's a year from now, this note actually okay, so we are adding 400,000 on a 5 million loan. So at the time of conversion, this note, we are assuming that this note has a principal including accrued interest of 5.4 million. So that's going to be its liquidation preference. Okay, it's 5.4 because it has to include the interest that we estimate is going to be accrued at the time of conversion. In addition to that, we estimate that the time to exit from the current moment all the way to the exit is going to be 3 years. So we have interest that accrue. The interest doesn't accrue all the way to the 3 years. It only accrues to the moment of conversion. And then from the moment of conversion to the time to exit, there is an additional space of time. If you add that to the time to conversion, we get to 3 years. So we expect an exit for this investment in a sale or M&A transaction or IPO 3 years from the current moment. So at the current moment, we have estimated by other means that the company's equity is equity plus loan value. So the company basically, not just the equity, the enterprise value for this company is 30 million. And now we allocate the 30 million down the cap structure. And we are treating the convertible notes essentially as if they were preferred with a liquidation preference of 5.4, more senior than the rest of the preferred stock. So first we allocate to the convertible notes, then to the preferred, and then to the common until it catches up to the rest of the value, and then pro rata on a fully converted basis, considering that the convertible is going to have more allocated to it because it converts at 0.8, not at 1. So with that, we get that this note now is not worth $1, it's worth, or €1, sorry, it's 1.37. And you see that at the bottom of the slide. Next. Now, this is another example. This is a model of calibration using the note as the basis for calibration. So we have this note that has just been issued. There hasn't been a new round of preferred, but there's been an issuance of this note. And we develop all this expectation. We expect that the note is going to convert once it accrues $400,000 of interest. We expect that the company is going to have an exit event in 3 years. Then we put in, all our other metrics, the risk-free rate, the zero dividend, of course, the expected volatility, and so on and so forth. And then we know that the note was issued at $1 per share. $1 per principal. So if it's a 5 million loan, $1 at inception. We back solve into this. Using the 1 million as the drive, the $1 per unit of principal as the driver, and we get to 17.2 million value for the enterprise value of the company. So next. Okay, so that's all. I mean, we went to a lot of examples, so I would like to give you, I'll welcome any questions at this point.
Yeah, thank you, Antonella. So, any questions from the audience? Maybe you have some experience with discussions with your auditors on this topic that you would like to share.
Well, as we, oh, okay, there. I see there is a question.
I'm curious how to model out when the debt doesn't go as planned.
So let's say that the company is encountering some challenges. First of all, some of the techniques that we discuss are still applicable. I mean, the first thing that would happen, let's say that the company is operating at less than, is underperforming. If the company is underperforming, before you still have to separate the case of distress, which is when there is an issue with real repayment of principal, and the situation where the company where the company still, the debt is still being serviced, so it hasn't been it's not in default, and there's still enough collateral to cover it. So in an initial situation where the company is still performing, and the company is underperforming, you would adjust the yield. So the risk of the company increases essentially. So you may have a company-specific risk adjustment, which involves an increase in yield and a decline in the an increase in yields and possibly a decline in the current value. The other consideration is that if you value that as part of a option pricing model, the option pricing model does include in its own structure the situation where the company is not going to cover in full basically where some of the equity or some of the instruments that you include in the OPM model may be worth zero or close to zero. So that's part of that analysis already there. And then you have the third situation where you know that there has been a case of default. So there, you may want to consider whether you have to switch model altogether, and then you get into a different type of situation where you may have to use a recovery analysis. So what you do there, you look at the collateral specifically, you look at the seniority of your debt, and then you make an assessment of how any cash coming from the collateral is going to be allocated, and then you estimate the time to the recovery, and you discount that to present value.
Thank you. There is another question. How do you determine the volatility estimates, like 70% or 75% in your examples? Maybe you can give some hints.
Yes, so for volatility, we typically look at guideline comparables with the understanding, so these are public companies that have features that are, I mean, for venture companies, the problem is, it's hard sometimes to find suitable comparables because these companies are very idiosyncratic. So the first thing that a fund manager is going to tell you, oh, my company is unique. It doesn't have, or the company management. There are no comparables. Okay, there are no comparables theoretically, but in practice, if an investor has to give money to a company, they will think, what am I going to do? Am I going to buy a public company, or am I going to, or some other type of company, or am I going to give money to this particular company? So, from the perspective of the investor, you can start thinking what could be possibly public companies that could conceptually provide an alternative to investing in your particular company. So once you select your comparable, then you look at what the market volatility of this comparable is over the term of your debt. And when you look at the term, you look at the term to repayment. So not necessarily at the term to maturity, because if you expect that the debt is going to be repaid earlier, or sometimes it's necessary to extend the maturity. So the contractual maturity is a reference to start with, but as you progress, you want to make sure that you use your expectation on when the actual repayment will take place.
Okay, thank you. We have two more questions. One in the chat box. How would you approach valuing debt that is convertible based on if the company raises X million dollars or greater of funding within a 5-year period of time? It's not a value-based driver for the conversion, but rather an event-based conversion.
Well, sometimes if you that sounds like a scenario environment where you may want to use a scenario analysis. So consider various scenarios and for conversion, assign probabilities to the various scenarios, and then figure out what your debt value currently would be based on this probability weighted analysis.
We talked about underperforming, and Norbert is asking, underperforming starts from when on?
Well, typically for venture debt, in most cases, there is a reassessment of value that takes place quarterly. This is part of also why it could be especially interesting for valuation analysts to get into these spaces, because there is a recurring situation. So it's not just that you need evaluation for a spot environment, or because you get to year end, you need an audit. I mean, generally these instruments have to be valued quarterly because the market changes every quarter and the company performance changes. So every quarter, basically what you would do is you would talk with the fund managers and with the company management, and you will discuss with them how the company is doing. So how is it performing relative to budget? Are they exceeding their revenue projections? Are they getting what they thought they were going to get? So that's a criteria. Same thing for profitability. And same thing for cash. Are they burning cash as they were expected to? Is it quicker, slower? So you look at a number of different things relative to the point in time when you enter into the deal, and then you update it every quarter based on performance.
Okay.
Yeah. Well, Wolfgang, may I ask a question?
Yeah, sure, Andrew.
I was just wondering, Antonella, from a practical perspective, if we consider the adjustment in the job creation numbers in the United States last week of neighborhood of about 818,000, and then the way that trickles through in terms of the potential expectations in terms of the economic growth and potential implications in terms of the Feds and other reserve institutions, possibly even extending beyond the United States around the world, in terms of the pressures that would have on interest rates. In the case of venture capital, I think it would create some potential upheaval in that particular market. So would the industry put a strap on basically moving in terms of new investments and assessing investment in that type of environment until there seems to be some time for the dust to settle?
Well, let's put it this way. I mean, the venture capital industry is highly sensitive to the condition of the capital markets, probably because of this need to raise funds regularly. So the indication that comes from the labor markets is certainly impactful. And it's one of the components that can put pressure, but I think at the moment there are lots of different pressure, in part also political. So, that's also an important variable on how that's going to play out in the next few months. And then after November, once the elections have taken place, what's going to happen after that. So I think there is a good deal of uncertainty at the moment. And we just have to, and also, there is the idea that I would expect that there is a restraint from making very significant moves that could significantly alter the markets between now and the US elections, at least for the US. If this can, I hope I address your question.
Thank you.
Thank you. Last question, very short question. Have you ever tracked how accurate your valuations are retrospectively? It's a good question to each valuator.
So, well, for that, that has to follow market. So in a way, in the inequity environment, you can look at where an exit has occurred versus where you were valuing it like 6 months before. And this is part of the analysis that we do, in our models to try to fine tune them, with the understanding that the markets can be very volatile in this space. Again, the condition of the capital market here also can be very, can have a very significant effect. For the debt environment, in a way, you have, to some extent, you have more pricing points. And the idea is that, by following it quarter by quarter, backtesting, the debt is going to tend to approach your maturity. If everything goes well and the debt is repaid at maturity, and it's issued as it often is at the discount, you're going to have an increase in fair value, over time until you get to your maturity repayment. So to that extent, the backtesting is different. The main concern there is to make sure that the company doesn't go out of business. That's what you need to monitor.
Yeah, thank you. Thank you, Antonella, for your very illustrative examples. And thank you to the audience that you shared your time with us today. Our next Around the Valuation World show will be held on September 13th. Also a topic with a link to option pricing, I think. The pricing of earnouts, how to bridge valuation differences with Bernhard Schwetzler from HHL University here in Leipzig, Germany. So yeah, thank you again, Antonella. Thanks, Andrew, for joining us. Thanks, Chanda, for the technical support. Thanks, Pratik, for joining us. And again, thank you to the audience. Hope to see you end of September, and take care. Have a great time.
Thank you. Thank you,
Thank you, Antonella.
everybody. Thank you
Bye.
so much. Pleasure.
Bye.